Welcome to Killik & Co.'s podcast for the 19th of August. First of all, a quick look back at last week where we saw continued increases in the rise in bond yields, particularly those in the US, but certainly in the UK as well. We saw rates increasing at the moment. This feels like the second leg up for yields at the moment and is clearly begging the question as to how much this rise in yields at the moment will have some impact on other asset classes as it continues to search at these new higher levels at the moment. This week, when we look at the diary, we will see that the FOMC will be publishing some minutes, but the very high expectation is that we will see the first of the tapering of QE programs taking place in September. So these minutes are going to be sort of quite keenly looked at for any wording that may change that particular stance as we look forward. So let's just take a look at that forward diary. Obviously, in the sort of middle of August, one expects it to be reasonably quiet, but there's certainly some interesting points. Tuesday, we'll be looking at German PPI. Last week, we saw GDP coming out across the Eurozone, and those numbers were broadly better than anticipated and certainly reflected the fact that Europe is seen to be putting its first quarterly positive number out there. Still, year on year, the Eurozone is still seeing declines in the rate of its GDP, but it is this quarter-on-quarter number that is giving some reasonable optimism that things are on the turn at the moment. Indeed, we're hearing even at the sort of Spanish end of the market and looking at property that we are seeing deals take place at the moment in the private equity world which are starting to reduce exposure of the banks to what is perceived to be some zombie assets down in Spain. So certainly some signs of life at the moment. Question is it all going to get snuffed out by these high yields in the US bond market taking rates up too prematurely? Other areas for this week, as I say, the FOMC meeting minutes on Wednesday will be the key talking point, I suspect, of the week. China HSBC flash manufacturing PMI number on Wednesday. That's always a well looked at statistic. Tends to be a little bit more bearish than other PMI statistics that come out from China. So again, expect that to create a bit of interest in the overnight markets. Eurozone flash PMI, really looking for confirmation or continuation of that more positive theme that is coming out of Europe at the moment. So a little bit thin on the corporate details. And that reflects the fact that we're broadly through the Q2 reporting season. So taking a look at the markets, and I mentioned that we are seeing a second leg up on US yields. We'll look at that chart in a moment, but it is beginning to weigh a little bit on equities at the moment. As this chart shows, we obviously, this decline that we saw, very rapid decline, was when tapering was first discussed in that sort of mid-May to mid-June period, and then softer noises, more dovish noises coming out from the central banks, particularly in the UK and Europe, really steadied the nerves of equities, and we saw quite a sharp rally, recovering the good proportion of that fall. But we're just starting to sort of taper off a little bit ourselves in equities at the moment. Sentiment just weighing a little bit. So clearly the two are very much in tune at the moment, and that's why I do encourage a continued sort of focus on these minutes for this week. I do think they will be fascinating for telling us more about the direction that the central banks there do wish to take. In terms of the UK itself, well, we had last week some retail sales numbers out which were quite strong, I mean much stronger than anticipated at the moment. Critics will argue that we seem to be recovering in the UK, but for all the old reasons. It's all to do with retail sales and house prices at the moment, and you could argue that what we want to see is certainly much more of a rebalancing. We will have some manufacturing numbers out in the UK this week, so maybe some stronger numbers there will help to give some cheer that there is a rebalancing or start of a rebalancing taking place. But it was retail sales last week that really shot quite hard in terms of higher than expected, and really gave cable, the value of sterling versus the dollar, quite a big shift up last week to 156. We've been here before, certainly been there before this year at the 162 level, but that is clearly an area of interest for us as we are seeking to rebalance. We probably like a little bit more of a competitive currency at the moment. That's working slightly against us for that. So these are the yields to focus on. This is the way that the 10-year gilt yield has moved over the course of the last 2 or 3 months, and you can see that it's rapidly sort of climbing to around 2.71% at the moment. I'm slightly less worried about the UK. Our average duration for debt is around 13 years at the moment, so levels of refinancing that have to take place year after year is much lower in the UK than it is elsewhere in the Eurozone at the moment. But do not underestimate the fact that these high yields at the moment will be putting a lot of pressure potentially back onto the Spain and Italy if we do see those yields start to blow out. At the moment they're still very much under some control, and spreads between that and German yields still remaining sort of quite low, so it's not a problem at the moment, but it's one that we do have to keep quite a close eye on. In terms of the US, well, as I say, 2.87% was a mark that we saw in late trading on Friday, around about 2.83% as we speak on Monday morning, but no question that this first leg up, period of consolidation, we are in that second leg at the moment, taking us into sort of reasonably uncharted territory, haven't been seen for a few years, and one that this level or speed of change in the yields at the moment is the thing that is beginning just to undermine a little bit of sentiment towards the equity market as we speak. A couple of stocks though to mention. Apple, the resurgence of Apple is well underway. $500 it touched last week, having been below $400 towards the end of June, so there is definitely a bit of resurgence coming back into Apple at the moment. Talk of a product launch on September 10 is always helpful to the cause there at the moment. And really just finally mentioning that these interest rates, sort of stocks that do become impacted by interest rates, I'm looking at the house building sector. Persimmon, which is a FTSE 100 company and one of the proxies for the sector, really demonstrated quite wide volatility last week. It came off very sharply as the thoughts of higher interest rates had an impact on the stock. We saw the shares fall by 7 to 8% one day, but good results led to a 4% increase at the moment. But volatility coming back into house building just at a point that we're hearing that UK house prices are on the rise.